How are things now? My name is Paddy, and welcome to the 9th episode of my podcast, Defining Cashflow. In today's episode, I want to look into the mortgage renewal wave here in Canada. This is something that's been discussed quite a lot over the last few years, and it's been covered reasonably well in Canadian media, and certainly covered a lot by real estate podcasters here in Canada. And there has been many assumptions that have been made about what the mortgage renewal wave actually looks like, and the most popular assumption is probably that because the peak in interest rates is now behind us, that the peak in the mortgage renewal wave must now also be behind us. But it somewhat upsets me when there's people out there making what they claim to be educational videos, but then they'll go on to simply guess or estimate what can be calculated and graphed out quite precisely. So I spent over 100 hours in Excel graphing out the mortgage renewal wave here in Canada, and this can be done perfectly accurately for any home that's renewed before now, because we know the average price home, or the HPI, the home price index in Canada, for any month up until now. And we know where interest rates have been in any month up until now. So we would know at what interest rate was that home purchased, as well as what interest rate that home was refinanced at. And then we can graph out the mortgage renewal wave into the future by making assumptions on where rates will be from here on out. And towards the end of this episode, I'll show you a graph which splits into 6 different waves from January 2026 onwards, which represent the mortgage renewal wave at 6 different interest rate intervals from here on out, between 3% and 4.5%. So if you'd like to look at what is, I believe, the most detailed analysis of the mortgage renewal wave here in Canada, continue to watch this video, and for anybody that would like me to send them my calculations or my Excels, I'd be very happy to do that also. To start, let us first look at the predictions set out by the Bank of Canada in this 2024 Financial Stability Report. In this report, the Bank of Canada predicted the percentage increase for various mortgage types throughout a number of different years. Here is the percentage increase for the 5-year fixed-rate mortgages. These are the most popular mortgages here in Canada. And the Bank of Canada has predicted that the largest increase upon renewal for these mortgages will occur next year in 2026. This is because the 5-year fixed-rate mortgages that renew next year in 2026 are renewing from the all-time low interest rates of 2021. The yellow bar represents the percentage increase in fixed-rate mortgages with a term of less than 5 years. The largest percentage increase in these mortgage types would have occurred in 2024, and this would be because the majority of these mortgages were 3-year fixed mortgages, and 2024 would have marked 3 years from these mortgages renewing at the very low rates of 2021. Next, we have the variable rate, variable payment mortgages. These are the mortgages where the monthly payment went up each time the Bank of Canada increased its overnight rate, and where the monthly payment would have come down again each time the Bank of Canada cut its overnight rate in recent times. These mortgages would have experienced their largest percentage increase in 2023. This was a time frame in which the overnight rate from the Bank of Canada would have peaked, and it coincided with the time in which we experienced the peak in the 5-year fixed-rate mortgage here in Canada. The 5-year fixed-rate mortgage peaked here in Canada right after we experienced the peak in the 5-year Canada bond yield. And the peak in the Canada 5-year bond yield occurred in October of 2023, at the same time where we saw the peak in the US 5-year Treasury yield. This would have happened because the Canadian government competes with the US government for the same investors to buy their debt. Once again, all of these bond markets are interconnected. And I think the core theme of this entire podcast is that everything in our economy is tied back to bond yields, as it is bond yields that determine the cost of borrowing and therefore determine the cost of money. It is worth noting that the Bank of Canada anticipated that the increase in these mortgages would go up again next year in 2026. And this could only happen if rates once again started going higher from here. But this is something that the Bank of Canada have once again doubled down on in recent weeks. And I always maintain that it's very important to listen to the Bank of Canada, as well as other central banks around the world, as they genuinely try their best to give us the most accurate forward guidance they can on their future policy rates. And finally, we have the variable rate fixed payment mortgages. These are the mortgages that the Bank of Canada predicts will see the largest increase in their monthly payments, and that this will occur next year in 2026. The monthly payment on these mortgages would have remained exactly the same over the last number of years as the Bank of Canada continued to ratchet up its overnight rate. This is because even though these mortgages are variable rate mortgages, they come with a fixed payment. And essentially what was happening as the overnight rate increased from the Bank of Canada is that the amount of interest that was being paid in each monthly payment kept on increasing, and the amount of principal which was being paid decreased. For the majority of these mortgages, it got to the point where the amount of interest that was being paid increased so much that the entire monthly payment was going towards interest, and absolutely none of the monthly payment was going towards principal. It even got to the point where the amount of interest that was being owed was so great that not all of the monthly payment was covering off all the interest, and the unpaid interest was being tacked on to the end of the mortgage. Because of this, the amount of time that it takes to pay off this mortgage was actually increasing instead of decreasing. This is what we refer to as negative amortization, where the amortization, or the amount of time it'll take to pay off the mortgage, is actually increasing, which is completely counterintuitive, as we expect to have less time to pay off a mortgage as we continue to make more mortgage payments. In some cases, the amortization on these mortgages ballooned out to 50 years or more. But these amortization periods need to be brought back to a standard amortization upon renewal. And in order to bring these mortgages back to a standard amortization, this will require a substantial increase in the monthly payments that will need to be paid on these mortgages. This is why the Bank of Canada predicts that it is these variable rate fixed payment mortgages that will experience the largest percentage increase upon renewal, and that this will occur next year. And finally, the black bar represents the percentage increase in all mortgage types together. And once again, the largest percentage increase when we consider all mortgage types together will once again occur next year in 2026. And this is because the majority of mortgages are 5-year fixed rate mortgages, as well as the variable rate fixed payment mortgages. So let's now look at a breakdown of the mortgage type per household in Canada. And we can see that 35% of households in Canada have an outstanding mortgage on their home. Out of the 35% of households that have an outstanding mortgage on their home, 70% of these mortgages are a fixed rate mortgage. And out of the 30% of mortgages with a variable rate mortgage, 80% of those mortgages are a variable rate with a fixed payment. In the pie chart on the right of the screen, we can see that the vast majority of households in Canada that have a mortgage, almost 75% of them, have a fixed rate mortgage. And we can also see that the variable rate mortgage with fixed payments is 4 times more popular than the variable rate mortgage with variable payments. It is very important to note, however, that back in 2021, which was the largest year ever for mortgage originations in Canada, because 2021 was the year in which the most homes were ever sold in Canada, that back in 2021, the variable rate mortgage became more popular than the fixed rate mortgage. This can happen at times of very low interest rates, but also I believe this happened in 2021 as home prices rose to a level that was so high that borrowers simply had to go with the best rate on offer in order to afford the homes at that time. This really increased the popularity of the variable rate mortgages at that time, and the vast majority of those mortgages were variable rate with fixed payments. So let's now look at the mortgage renewal wave here in Canada. And first, let's look at the inputs that I use when calculating this mortgage renewal wave. Firstly, I use the aggregate composite MLS HPI home price index from CREA, the Canadian Real Estate Association. Here is the HPI from CREA graphed out in Excel. And we can see that the HPI, the home price index, peaked in Canada in early 22, and that we're down over 18% from the peak since then. Secondly, I used the 5-year fixed rate mortgage rate from StatsCan. Once again, we can see that the 5-year fixed mortgage rate in Canada peaked in November of 2023. Next, I used a 25-year amortization upon origination, which I then reduced to 20 years upon renewal of the mortgage at the 5-year mark. Also, I used a minimum down payment on the mortgage in my calculations. However, it is very interesting to note that the percentage increase in mortgages stays the same regardless of the percentage down payment upon origination and irregardless of the original home price of the home. This may seem like a very simple statement, but I spent hours in Excel ensuring that this was correct, where I graphed out the percentage increase in the mortgage using various home types and various interest rates upon origination, as well as various down payments. And I was able to calculate that the percentage increase in the mortgage upon renewal remains to be the same irregardless of the home price and irregardless of the percentage that was put down in a down payment upon origination. I also conducted these calculations at various interest rates upon renewal at the 5-year mark. And once again, I was able to see that the percentage increase in the mortgages remains to be the same, irregardless of the original home price and irregardless of the percentage that was put down in a down payment. And doing all this extra work ensured that I now understand mortgages much more deeply, much more than I would if I'd never gone through this process. Also, because the minimum down payment was used in my calculations, I ensured to include the CMHC insurance as part of the mortgage. The cost of the CMHC insurance can be included into your mortgage and therefore paid back over time. And we looked at this in episode 1 of this podcast at the very beginning of the year. And then, after putting all this data into the Excel, and after spending what I assume to be an extra 100 hours or more in Excel, I was then able to graph out the mortgage renewal wave here in Canada. And this is the final result. This is the mortgage renewal wave in Canada graphed out in Excel, using the 5-year fixed rate which we know up until this point, and then making predictions on where the 5-year fixed rate will go from here. Put it into context where we are in this wave. The grey shaded area is this year, 2025. And we can see that the Bank of Canada back in 2024 had predicted that the maximum increase in the 5-year fixed rate mortgage in 2025 would be roughly 22%. And we can see from our calculations, where we now know the interest rates in Canada throughout the entirety of 2025, we can see that the Bank of Canada were extremely accurate with their predictions. We can then see that the Bank of Canada predicted that the percentage increase in the 5-year fixed mortgage rate would be even larger next year in 2026. So let's now look at how the percentage increase in the 5-year fixed mortgage rates upon renewal may reach a level of 26%. Based on a current 5-year fixed rate of 4.24%, which is where the 5-year fixed rate is here in BC upon recording this episode, we can see that the maximum percentage upon renewal of the 5-year fixed rate mortgage will be in the range of 24% next year in 2026. And we'll see that there was a substantial jump in the increase upon renewal for the 5-year fixed rate mortgage in December 2025 alone. In fact, if rates had stayed at 4.05%, which is where they were at the start of December, the blue line here would represent the mortgage renewal wave if rates were to have stayed at 4.05%. However, earlier this month, rates jumped to 4.24%. And the orange line represents the increase in mortgage payments for the 5-year fixed mortgage based on this mortgage rate. So why did the fixed rate mortgage jump so much in December when the Bank of Canada held rates earlier this month? Well, this is because the 5-year fixed mortgage rate here in Canada is dependent on the Government of Canada 5-year bond yield, and not just the overnight rate from the Bank of Canada. As we know from earlier episodes of this podcast, bond yields, and especially longer-term bond yields, are made up of more components more than just the central bank policy rate. And it is because we saw a substantial increase in the Canada 5-year bond yield earlier in December that the fixed rate mortgage here in Canada increased shortly after that time. And the Canada 5-year bond yield increased substantially at the start of December due to a substantial increase in the Japan 5-year bond yield. Once again, it is very important to understand how all of these bond markets are tied together, and it's very important to understand how changing bond yields in the major economies around our globe affects everything in our economy. So once again, we can see the mortgage renewal wave, which is perfectly accurate up until December of 2025, as we already know where rates have been up until this point. And then we can see the percentage increase in mortgage renewals if rates had stayed at 4.05% versus the mortgage renewal wave with rates at 4.24%. But we still don't have a percentage increase in our 5-year fixed mortgage rates of 26%, just like the Bank of Canada had predicted. So how did we get to the percentage increase in the 5-year fixed mortgage rate upon renewal next year being as high as 26%? Well, if the 5-year fixed rate here in Canada were to jump by another 20 bips in either January or February, this will bring the maximum increase in renewals for the 5-year fixed mortgages next year to 26%, just like the Bank of Canada had predicted. And because nobody can know for sure where the Bank of Canada 5-year bond yield will go from here, and therefore where the 5-year fixed rate mortgage in Canada will go from here, I've worked out the mortgage renewal wave at a number of different levels for the 5-year fixed mortgage rate. And we can see that if rates stay in the range of 4% or higher, that the peak percentage increase in mortgage renewals for the 5-year fixed mortgage rate here in Canada is still ahead of us. And if you were to take a screenshot of this screen, you'll be able to see the exact percentage increase in the 5-year fixed mortgage rate in Canada upon renewal in any month throughout 2026 at various interest rates. So let's now look at why there has been a substantial jump in mortgage payments upon renewal for the 5-year fixed mortgage here in Canada in the second half of 2025, as well as for the first half of 2026. Essentially, this is because these are the mortgages which are renewing from the all-time low rates of late 2020, as well as for the majority of 2021. The percentage increase in mortgage payments is solely dependent on the differential in rates between origination of the mortgage and renewal of the mortgage. And even though the 5-year fixed mortgage peaked in 2023, these mortgages were originated at the relatively high rates of 2018. But if we were to fast forward on 5 years from the time at which rates were at the lowest in late 2020 and for the majority of 2021, this is where we will see the peak increase in the 5-year fixed mortgage in Canada at renewal take place in late 2025 and potentially for the majority of 2026. Then, if we were to look at the period in time which we will experience the largest dollar value increase in the 5-year fixed rate mortgage upon renewal, this time frame lags the time at which we experience the largest percentage increase in mortgage payments. And this occurs because even though the 5-year fixed mortgage rate began to climb in early 2021, and remember, the 5-year fixed mortgage rate in Canada is dependent on the Government of Canada 5-year bond yield, which started to rise in late 2021, as opposed to the overnight rate from the Bank of Canada, which didn't see its first increase until March 2022. Home prices in Canada continued to ratchet higher until the spring of 2022, despite the fact that the 5-year fixed mortgage rate had been increasing for several months now. It wasn't until the Bank of Canada started increasing its overnight rate that the general public in Canada realised that rates were going higher and therefore stopped bidding up home prices. And the largest mortgage payment for 5-year fixed mortgages in Canada doesn't occur until March of 2027, which is exactly 5 years from the peak in prices. So we can see a substantial lag between the largest percentage increase in mortgage payments versus the largest dollar value increase in mortgage payments versus the largest mortgage payment upon renewal. Remember this lag effect. This is extremely common across all of economics, and we will look at other examples of this lag effect in our episodes. Also note that where the percentage increase in mortgage payments is not dependent on the purchase price of the home, it's only dependent on the rate differential between origination of the mortgage and renewal of the mortgage. The dollar value increase, as well as the largest dollar value payment at renewal, is dependent on the original value of the home. And even though interest rates bottomed out in 2021, it is because home prices didn't peak until 2022 that we don't experience the largest mortgage payment upon renewal until early 2027. And we can see that the monthly payment upon renewal, for someone who would have bought a home in Canada at the benchmark price or at the HPI price in any given month in Canada, will therefore be renewing at a much higher payment in early 2027 than they would have had if they had renewed in mid-2023. And we can see that the percentage increase at renewal, as well as the dollar value increase at renewal, doesn't begin to come down substantially until 2027. And this will remain to be the case unless mortgage rates in Canada come down substantially between now and then. And remember that it is the variable rate fixed payment mortgages that will be our largest concern. And when we consider that it is the rate differential between origination of a mortgage and renewal of a mortgage that determines the percentage increase in monthly payments, consider that mortgage rates in Canada have been on the decline now overall for almost 50 years, with a few relative increases along the way. Here is the increase in mortgage rates in the early 1990s, which was the cause of the most recent and most substantial correction in Canadian home prices over the majority of our lifetimes. But do note that today's correction in Canadian home prices nationally has already surpassed that of the early 1990s. But despite mortgage rates have been coming down overall in Canada over the last 50 years, economists now warn that we may have entered a new rate cycle environment. And there have been a number of warnings, including a very clear warning from the US Federal Reserve a number of years ago, that rates may now be higher for longer. But let's set aside any concerns about bond yields and therefore mortgage rates going higher for just a moment. And let's simply look at the mortgage renewal wave at current mortgage rates, which is around 4%. And what I've learned throughout this process is when we're calculating the percentage increase or decrease in a mortgage payment upon renewal, the main thing we need to focus on is the rate differential. the difference in rates between the time in which we bought the home and the rate at the time in which we're refinancing that mortgage. And for that reason, we need to be focused on the period of time, which is 5 years from the period in time in which we had ultra low rates, which was in late 2020 and all throughout 2021. And 5 years from that time is right now in late 2025 and for the majority of 2026. This is a time frame in which borrowers will have the largest percentage increase upon renewal if rates are to stay where they are, around 4%. And it's not so much the 5-year fixed mortgage rates that I'm concerned about, it's the variable rate fixed payment mortgages. And then we look at the lag effect. The lag in time between the period where we have the largest percentage increase in mortgage payments versus the largest dollar value increase in mortgage payments versus the point in time where we have the largest payment overall upon renewal for someone who would have bought the average price home in Canada in any given month. The largest dollar payment upon renewal for someone who would have bought the average price home in any given month in Canada incurs in spring of 2027, which is exactly 5 years after home prices in Canada would have peaked in the spring of 2022. And the main reason that this mortgage renewal wave overall is of interest to me is because it fits in so well with something that Ray Dalio covers in detail in his video where he looks at how the economic machine works. Ray talks about a period in time where people have to put more money towards servicing existing debt, and therefore they have less money to spend in the real economy. And Ray is very clear that this period in time signals the start of the end of the short-term debt cycle. And he goes on to say that the short-term debt cycle almost always ends in recession. And when it comes to the Canadian housing market, it's not a case that I'm concerned that a huge surge in mortgage delinquencies is going to be the catalyst to drive prices lower. And I think that's why people can sometimes get a little bit upset and defensive when I share with them my outlook for Canadian real estate, because for anybody that has a mortgage, and if I'm telling them that I believe home prices will go down from here, they think that it's because I believe that they, as well as other people like them, will all of a sudden become delinquent on their mortgages. But that's not what I'm concerned about at all, nor have I ever been concerned about that when it comes to the overall health of the Canadian real estate market. What I've been concerned about for years is the massive overbuilding of pre-sale condos in our cities of Toronto and Vancouver. This product was sold at a 40% premium to resale product back at the peak in 21 and 22. It was very easy at the time to envisage that the value of these properties would go up by another 40% over the next 4 years, the time it took to build those properties, because in 2021 alone in Toronto, prices went up by 22%. So if they went up 22% in 1 year, we can definitely envisage them going up another 40% over the next 4 years. But not only have resale prices not gone up by 40% over those 4 years, in fact, resale prices have come down. And the rate at which resale prices are declining is now starting to accelerate in Toronto. So many of the people who will be closing on these units are closing on a unit in which they've agreed to pay 50% above current market value for these units. And if they were to close on these units and rent them out for top dollar, they'd find themselves with a negative cash flow of $1,500 a month, meaning that they'd have to supplement the rent with an extra $1,500 every single month simply to cover the cost of carrying these units. And it's not that I'm overly concerned with people being unable to close on these units that they've signed a contract to purchase, nor is it that I'm concerned that they'll be unable to make up the shortfall between the rent and the carrying cost of these units. What I'm concerned is that we won't have enough more potential buyers willing to put themselves in this situation, that we won't have enough more potential buyers willing to pay 40% above current market value for these new pre-sale units. And if they were to buy these units with the hope that prices would start going up again, well, they'd be paying an extra $1,500 in negative cash flow every month as they're waiting for prices to appreciate. And it's no longer a prediction that demand will go away for this product type. It's now being well covered that demand has already very much gone away for this product type, and the demand for new condos in Toronto is now at multi-decade lows. And this is all happening at a time where we'll have an all-time record of supply, with 2 huge years of supply both this year and next, where there could be another 30,000 units coming to completion in Toronto next year. And a substantial percentage of these condos may still be unsold, perhaps 10% or 15 or 20 or maybe even a little bit more. Because the record in developers holding back units to sell at a future date, that happened at its peak during the peak in pricing in 21 and 22. When the prices of resale condos in Toronto were going up by 20% in 1 year in the year 2021, it simply didn't make sense to sell a product that could be worth 10% more in 6 months or maybe 20% more in 12 months. So the current situation we have in the Toronto condo market is we have persistent multi-decade lows meeting all-time record high supply. And when you have such a mismatch between supply and demand, that's usually where prices have to correct to make up for that mismatch. So if you'd like to continue to follow along as we cover the Canadian real estate market and we cover the main macroeconomic themes in our global economy, please like and subscribe. We'll see you all again soon, hopefully.